A stock exchange crashes in New York. A currency collapses in Asia overnight. A European government suddenly changes course. These events seem unrelated, but the fingerprints are often the same. The truth is uncomfortable. The most powerful force in the global economy isn't a government or a central bank. It's a borderless system that operates outside elections and public view. Most people never see it, yet their jobs, savings, and economies depend on it. The real question isn't who prints money, it's who controls global liquidity. Why the national money story is outdated. Most people are taught a simple model of money. Countries issue their own currency. Central banks manage interest rates. Governments borrow, tax, and spend within national boundaries. This story was never fully accurate, but in the modern financial world, it is dangerously incomplete. Today's financial system is deeply interconnected. A funding problem in one region can destabilize economies thousands of miles away in days or even hours. These shocks don't travel through trade routes or diplomatic channels. They travel through financial plumbing, short-term lending markets, offshore dollar funding, and cross-border balance sheets. Money no longer stops at borders. It circulates globally, and the system that controls that circulation does not answer to voters. The dollar paradox. One statistic captures the imbalance at the heart of the modern system. Roughly 90% of global foreign exchange transactions involve the US dollar, yet only about 4% of the world's population lives in the United States. That mismatch is not symbolic. It is structural. The global economy runs on a currency that most countries do not issue, do not control, and cannot replace. Governments from Asia to Africa to Europe borrow, trade, insure, and hedge in dollars. Corporations raise dollar debt even when their revenues are in local currencies. Banks outside the US hold massive dollar liabilities they must constantly roll over. This dependence creates a system where global stability hinges on access to dollar liquidity rather than domestic economic fundamentals. The dollar liquidity network. What actually controls world money is not a single institution, but a network. This network includes the US Federal Reserve, foreign central banks, global commercial banks, offshore dollar lenders, primary dealers, repo markets, and enormous clearing and settlement institutions. Think of it as a circulatory system. The heart sits in the United States, where dollars are ultimately created, but the arteries stretch across London, Asia, the Middle East, and offshore financial centers in the Caribbean. A large share of dollar creation and lending happens outside the US banking system entirely, in what is often called the Eurodollar or offshore dollar market. These dollars don't appear neatly in national money supply statistics. They exist as liabilities and promises between institutions, layered on top of one another through leverage and trust. Why shadow money moves faster than policy? Official monetary policy is slow by design. Central banks debate rate changes, publish guidance, and adjust tools cautiously. The shadow dollar system does not wait. It reacts instantly to fear, opportunity, and funding stress. If central bank policy is the steering wheel, the offshore dollar system is the engine. It determines how fast money moves, where it flows, and who gains access to cheap funding. Governments can attempt to slow inflation or stimulate growth, but global liquidity flows can overwhelm those efforts. When global dollar demand spikes, domestic policy becomes secondary. Economies tighten whether local officials want them to or not. Who decides who gets oxygen? Liquidity is economic oxygen. When it flows freely, markets function, governments borrow easily, and businesses expand. When it dries up, everything suffocates. Access to dollar liquidity is not distributed evenly. Institutions closest to the network, major global banks, large asset managers, and countries with strong financial ties to the US, receive support first. Others face higher borrowing costs, capital flight, and currency collapse. This hierarchy is not written into law. It emerges from balance sheets, clearing access, collateral quality, and institutional trust. But the outcome is clear. Some economies are protected by proximity to liquidity. Others are exposed. When the system breaks, the hidden empire usually goes unnoticed because it works quietly, but when it fails, the consequences are unmistakable. In 2008, the global financial crisis did not begin with homebuyers missing mortgage payments. It escalated when offshore dollar funding markets froze. European banks that relied on short-term dollar borrowing suddenly couldn't roll over their debts. Dollar liquidity vanished. Global trade and credit collapsed. The solution did not come from elected leaders. It came from emergency dollar swap lines opened by the Federal Reserve, allowing foreign central banks to access dollars and funnel them into their own financial systems. Without that intervention, the crisis would have been far worse. March 2020 and the dollar shortage. The same pattern reappeared in March 2020. Markets collapsed not because of lockdowns or earnings forecasts, but because the world ran out of dollars. Investors scrambled for cash. Even U.S. Treasury markets, the safest assets on Earth, stopped functioning properly. Governments around the world faced a funding crisis. Dollar-denominated debts became unmanageable overnight. Once again, the turning point came when the Federal Reserve expanded swap lines and emergency lending facilities on an unprecedented scale. A handful of unelected officials made decisions that stabilized the global economy. Presidents, parliaments, and voters were not consulted. They did not need to be. The system had already decided where power resided: the democratic problem. This structure creates a serious legitimacy issue. The global money supply is effectively managed through institutions that are insulated from democratic accountability. Decisions that affect millions of jobs and trillions in wealth are made behind closed doors by financial technocrats. This is not the result of a secret plan. It is the outcome of decades of incremental evolution. Each crisis led to new tools, new facilities, and deeper integration. Over time, the system became too complex and too essential to dismantle. Now, nations depend on it even when they criticize it. Why countries can't escape? Many governments talk about reducing reliance on the dollar. In practice, escape is extremely difficult. Global trade is priced in dollars. Commodity markets run on dollars. Financial hedging requires dollar liquidity. Even countries that position themselves as rivals to U.S. influence rely on dollar funding to stabilize their own economies. Attempts to build alternatives face coordination problems, trust issues, and scale limitations. The dollar network persists not because it is perfect, but because nothing else can replace it at global scale. Global money, local consequences. The shift from national money systems to a global liquidity network has real consequences for everyday life. Domestic policy loses effectiveness when foreign capital flows dominate. Interest rates move in ways local conditions don't justify. Asset prices inflate unevenly. Inequality widens because those closest to liquidity benefit first. Financial institutions, asset owners, and major corporations gain early access to cheap funding. Wages and public services lag behind. Crises also become structural rather than accidental. When liquidity expands too fast, bubbles form. When it contracts suddenly, crashes follow. The system oscillates between excess and shortage, a system that grows stronger with each crisis. Every emergency intervention stabilizes markets, but it also reinforces the system's centrality. Each bailout expands balance sheets. Each liquidity facility increases dependence. Each crisis teaches markets where to turn for survival. Over time, power becomes more concentrated. The network grows larger, faster, and harder to control. Governments lose leverage, even as they rely on the same institutions to prevent collapse. This is not a story of villains. It is a story of unintended consequences, the real source of global power. In the modern world, power no longer comes primarily from armies or elections. It comes from the ability to create, distribute, and withhold liquidity. Control over funding determines which economies grow, which currencies survive, and which governments retain stability. That power resides in invisible infrastructure, clearing systems, swap lines, repo markets, and institutional trust networks that operate continuously beneath the surface of daily life. Most people never see it. They only feel it when it fails. The uncomfortable question. We no longer live in a world where each country controls its own economic destiny. We live in a world shaped by a single monetary ecosystem, held together by leverage, confidence, and dollar-denominated debt. The question is not whether the system is fair, it is whether it is resilient. Because if the hidden empire that controls world money ever fractures beyond repair, the vacuum it leaves behind will not be filled by voters or politicians. It will be filled by chaos. And when that moment arrives, the real question will be simple and terrifying. Who is actually left in charge? The money system only works because people trust it to keep working. And most of that system operates quietly, out of sight, until something breaks. If you want to understand the hidden forces shaping your money, your job, and your future before the next crisis hits, you're in the right place. If this video helped you see the world a little more clearly, like and subscribe for more deep dives into the invisible systems running everything around us.